literally before FinChat, I was copy pasting, like put the 10K on one side of my screen, put my Excel file on the other side of my screen, and then just go down the list and just type it all out myself. So really, we are really privileged in this day and age to have tools like this to shortcut our research.
Oh, yes.
And so in the case of Baba, they have a China commerce revenue type. They have a international digital commerce revenue type. They have some digital media and entertainment. And so you can see what the revenue picture is for each of those segments. And then, every company is going to report different KPIs and things of that nature. But for Baba, they do show the EBIT numbers. And so for me, depending on what part of the moat I'm most excited about, I would want to double check what's the revenue picture, maybe what does that look like compared to peers, and then what's the profitability. In the case of Baba, only Taobao and Tmall Group has positive EBIT, but I'm assuming the negative EBIT segments are probably growing like a weed. That's what you tend to see with high growth type businesses. And so when I pulled up Baba on QuickFS, 31% 10-year CAGR on revenues, 10% EPS CAGR on revenues. On EPS. So growing quite well, and they've posted some ridiculous year-over-year revenue numbers. 2021, they grew revenues by almost 52%. So truly insane revenue growth. The profits is something to watch, but I do know based on the shareholders letter that they have a very future forward mindset on a lot of the things they're doing. So those are all kind of the next, as I go down the next step of analysis when I'm doing a bird's eye view on a company, taking those baby steps into analyzing the company and trying to understand it. Those are the things that come into my mind, and some of the ways you can move past that more quickly. And FinChat's one of the great tools for that.
Yeah, it really is. So if you are kind of trying to parse through the company, once you have a handle on maybe what they do you kind of do a cursory look through the financials, i.e. the income statement, balance sheet, cash flow statement? Do you try to use metrics, or do you just look at the raw data and go, okay, this is a trend here, this is a trend here, that kind of thing?
Yeah, that's a tricky question to ask a data-driven person.
The answer is yes, all the above.
The answer is yes. I like to pull it up on quickfs.net. Old habits don't die easily. And so that's what I do. I kind of scan through and look, is there anything that just jumps off the page? Any numbers that really jump off the page? And so to bring it back to what I was saying before, you're growing revenues at 30% a year, but you're growing EPS or earnings per share at 10% a year. That's interesting. I want to figure out why that's the case. Not to say it's a bad thing, but that is interesting because usually EPS will increase along the same lines as your revenue or your sales. So in the case of Baba, that was the first place I looked was, all right, why is revenue growing so much faster than earnings? And so in the case of their margins, there has been margin contraction and it has not been cyclical. So for example, if you look at a steel company, the margins are going to be all out of whack depending on where you are in the cycle because it's a huge boost, huge boom, huge bust kind of company. In the case of Baba, they had, a small drawdown in revenues in 23, but it wasn't anything crazy. And I don't see big swings in the profit margins. It's more been a steady decline. So then doing that cursory scan of the numbers and just looking and observing from the top level, is there anything that really stands out to me that's different than other companies I'll look at? And then that takes me down what my next rabbit hole would be. So in this case, why is gross margin down from 68 to 38? Not to say it's bad, but just to say I want to know and understand why. And so that would be the next part of the 20F that I would focus on for Baba.
Yeah, that's a good takeaway. I would do the same thing. I would look through the margins and see if there's any sort of trend, whether it's up or down or sideways, to give me an impression on that. I noticed as we're looking at FinChat with the company, I noticed that they have been experiencing some impairment of goodwill as well as asset write-downs over the last few years. and as well as a couple of bigger legal settlements. I guess that was like 4 years ago, but there's been some, I would call it trash in the income statement that has been impacting their income, their net income, their earnings. And so when you see some of those things, asset write downs or any sort of legal impairments, things of that nature, generally a lot of that's one offs. But if you see them over 3-4 years, I think that's definitely something you want to dig into and look at. And again, these are just questions you want to ask yourself as you're kind of scrolling through the company. And that's something that kind of jumped out at me as I was looking through their income statement. And I want to know why. I want to know what they are. As an outsider, I want to understand that if I buy this company, is this something that could be a potential risk to my investment? Or is this something that maybe happened with previous management? Because there was a change in management a while ago, kind of during the pandemic. Jack Ma, who was the founder, was forced out of the company. And so I don't know all the ins and outs of that. So I just saw that from the outside. So that is something I definitely want to investigate.
Yeah, that's an awesome thing to do. And yeah, it does show it right there quite clearly on FinChat on the income statement. What else? What else do you look at? Do you kind of, does that wrap up the overview, or what's the next step for you?
I mean, if I just look at, I would look beyond the income statement and look at the balance sheet and the cash flow statement to see if there's anything in there that jumps out at me. I don't, just doing a cursory glance through them, I don't see anything crazy nuts that would jump out at me that would make me go, no, hard pass. It's just more of the, okay, what's this? What's this? Those kinds of things that would make me question, why is the company, why are they doing this? Is this a good thing or a bad thing? And everything on the balance sheet to me looks pretty normal-ish. Like, things like that would cause me questions, like debt, or are the liabilities bigger than the assets, kind of thing. Any of that kind of stuff, it all looks good. Like current assets are larger than current liabilities, for example. They're growing the equity. The total assets is growing. Well, it's been pretty steady, but all those things don't make me go. They also don't make me go, oh my God, this is like the cleanest balance sheet I've ever seen. It looks normal. If I looked at Amazon's, for example, I would think, same thing. Right? Okay, strong company, more assets than liabilities. Equity is growing. Those are all good things.
Yeah, long-term debt hasn't grown an egregious amount, and
Mm-mm.
compared to the equity, I think it's been decreasing. So that's pretty good.
Yeah.
So that's a good thing to do. I would add that later on in the process, as part of my checklist, I'm actually digging into those numbers. And I recommend doing that for anything you buy also. Like actually look at the solvency ratios, the liquidity ratios, all of those things. I hope that goes without saying. So one last thing I noticed when I was looking through QuickFS is I see out of nowhere there's a dividend payment in 2024. So then
Oh.
that gets my thoughts on capital allocation. And then so flipping to the income statement, you see that shares have been reduced several years in a row. And so that becomes interesting to me personally because I like to generally invest in companies that are already returning cash to shareholders because it's one less uncertainty. Like, now they're in that stage and that it's going to be difficult for them from an incentives basis to move away from that.
Mm-hmm.
And so statistically, those tend to perform better, over a large number of companies. And so that's why I like to see that.
Mm-hmm. Yep, I agree. And if you kind of dig a little deeper into the capital allocation, you can see they spent roughly 40 billion on buybacks over the last 3 years, as well as starting to pay a dividends. Those are indications to me that management is thinking seriously about trying to return capital to shareholders.
Mm-hmm.
And
Sure.
top that with the free cash flow looked like it's pretty steady, so that indicates that the company is profitable and they're able to continue to keep growing and spend enough to continue to keep growing, but also as they're probably more on the air quote mature side, they're probably looking at ways that they can return capital to us, which is always a great thing.
Yeah, that's another way to describe being in that capital return stage. And it's funny in the shareholders letter, they do mention this too. I like the way they said it, so I'm going to quote it. This is from the chairman and the CEO. In the past 25 years, Alibaba has grown consistently, but unfortunately acquired, quote, large company characteristics. So, they reinforce that they are still have this entrepreneurial mindset, and they have a mission, and they're doing long-term thinking, but that is something that they are dealing with. And for some investors, they don't like that because they're trying to swing for, super big home runs.
Right.
And that's something to, I think, always try to figure out. Like Brian Feraldi talked about when we had him on the show recently, companies have life cycles. So as you're analyzing a company, it probably helps to figure that out sooner than later. Because if it doesn't fit your investing style, then you're just wasting time. And there's too many fish in the sea to waste time on something you're not interested in.
Yep, exactly. To kind of further that point, I read some analysis on the recent news that Amazon is requiring employees to come back to the office and work. Is that I think upper management feels like the company has gotten too big and they can't execute fast enough. This person was speculating that the reason why they're doing this is to kind of thin the herd a little bit and be able to make the company leaner so that it can execute on ideas that it wants to do.